Thought leadership from PwC's National Office.
Hello, and welcome to PwC's Accounting Podcast. I'm Heather Horn. We're almost done with 2024, a year that had it all from the perspective of the finance team, from new SEC and FASB guidance to court challenges, and even a presidential election that could affect some regulatory agencies. Our National Office leader and professional practice group leader join us to share the top things they believe CFOs and their teams should know about the year that was as the calendar turns to 2025. This episode kicks off our year-end toolkit series that will run throughout January, bringing you a range of topics designed to help you through the year-end close process. Even if you're not currently at year-end or involved in the company's close, this information is still relevant and foundational to all finance teams. Because who doesn't love a year in review?
I'm not expecting pencils down between now and the time things change. In fact, I think over the last couple of weeks, the pace at which guidance and communications have been coming out have been accelerated. And you can understand both sides of that discussion.
That was Tim Carey, PwC's National Office leader, who's joined by Kyle Moffatt, PwC's National Office professional practice leader. Together, Tim and Kyle share important insights about these top 10 things to know and what it means for your reporting at year-end and next year in 2025. Let's play the episode. Tim, Kyle, welcome back to the podcast. And Kyle, it's so nice to have you on the other side of the microphone for today, having to give some input into these topics. And I think this is going to be a very exciting conversation about the hottest accounting, reporting, and auditing topics of 2024. And even as I said that, I was thinking those words may not belong in the same sentence, but listeners, I promise, today perhaps they do.
Exciting times.
Exciting times. So I think, overall point of today is not really to get into the detail, but more to give a year in review. And I think with so much that's going on both in the world and in accounting, reporting, sustainability reporting, it's kind of hard to take that step back and say, okay, what does this all mean? So hopefully today can help bring it together. Now, with that said, I thought where we could start is just some of the external factors that are impacting reporting. And so, Kyle, I'll go over to you to kick things off, just the election, what this means, and what we think particularly when we look back and look ahead.
Yeah, so look, I think, Tim and I both attended the AICPA conference, which is held every December in D.C. And obviously, I think this was probably the one of all the conferences I've attended that was probably more politically charged than any I've ever seen, frankly, in my entire career. And I think, largely due to the fact that you will have a Trump administration, and you will see kind of the pendulum swing back in the direction of, likely less regulation. I think likely changes in kind of how the SEC does a lot of their work, potentially changes with the PCAOB. We heard a lot of that commentary when we heard from Commissioner Ueda, who is likely either he or Commissioner Peirce, both Republicans, will likely be named as acting chair for a period of time. But look, here's the thing: we know that there is a transition team, like with any other government agency, and that transition team pretty much hits the ground. They're working now, but they will be in the building at the SEC. They will be focused on pretty much helping the leadership team transition to this next leadership team. We do know that Paul Atkins, a former commissioner, was nominated by the President Trump. I think that means Chair Gensler is out, and Chair Gensler has indicated he will step down on Inauguration Day, which is very interesting. Usually they leave beforehand. That transition team will likely go into the building and start the process of kind of figuring out, are there things that they can do in the near term for the next couple of months until Paul Atkins is appointed, voted in or confirmed by the Senate, which we could see probably sooner than what we've seen in prior periods. Usually it's around the April-May timeframe, and I think in this case it might be sooner. And so we heard from Ueda that there's going to be a focus on revisiting a lot of some of the governance areas that have been that we saw with the Dodd-Frank Act years and years ago that this current leadership team really focused on, kind of bringing, at least finishing the projects or finishing those rulemaking. So pay versus performance, CEO pay ratio, a number of topics. They'll focus on proxy advisory firms, shareholder proposals, much more. And Commissioner Ueda even talked about the PCAOB and kind of what they're thinking about doing the PCAOB. We certainly could see when this new chair is appointed that there may be a focus on changing out, at least at a minimum, the leadership of the PCAOB. So Chair Erica Williams, she was put in that role by the Biden administration and by Chair Gary Gensler. So I think we could certainly see some changes there. But I do think we the leadership, we've heard from a lot of these folks, and what we've heard from one of the representatives from the Republican side of the House, essentially saying that and he is now named the chair of the House Financial Services Oversight Committee. So certainly heard from him that he's looking to change things up.
The one thing that did stand out to me was a definite message from the Republicans that it was time to put pencils down until new appointees had been named, and there was a point of view by the Democrats that the work that had been undertaken and was in process was going to continue to be released. So there was a lot of back and forth.
Oh yeah.
And said in very direct ways.
Right.
Yeah, and I guess maybe for either one of you, and not to get too much into the detail from what I heard, I was not at the conference, but that there was sort of this is not business as usual. This is not just a routine annual update, but there's some real maybe frustration or otherwise in the air that's going to be, I'll say, dealt with over the next year.
I certainly picked up on that. It was a very interesting conference, a lot of tense conversations, a lot of accounting and auditing drama for sure.
Yeah, it's shocking. I mean, it's shocking.
Kind of.
Well, I mean, I look back to like 25 years ago when I started at the SEC, and then fast forward to where we are today, and it's night and day, because you used to have commission votes that were 5-0, and now commission votes are 3-2 party lines. And I don't think that's going to change. It's certainly not going to change during this upcoming Trump administration. I mean, it'll be interesting to see who is put in these various roles, but we will see a big change in the commissioners. So Jaime Lizarraga, one of the commissioners, Democratic commissioners, has indicated he will step down for personal reasons. We will see Hester Peirce, the Republican commissioner. She has indicated she'll leave at the end of her term, which is this year. So that's going to be a lot of turnover. I think there's a lot of conversations about Caroline Crenshaw. So look, I think we will see a very different SEC leadership, and then what happens is we see that trickle down throughout the organization. It certainly will impact the enforcement. It'll impact rulemaking. We'll see the agenda completely switch. But it's going to be a while before we really see what this next chair will focus on. I think he'll be open about what he wants to accomplish. But as far as like particular rulemakings, I think it will take a while before they actually put that rulemaking agenda together before it's actually published.
Yeah, so it's interesting, again, I think for your average person who's listening, where it's people in the world of accounting, what actually happened itself at the conference probably is not quite as interesting as just this overall idea of the tenor and sort of what we expect to see. So just one more question before we move on then. Do we really expect to see then sort of a cliff? Or as you said, I mean, Tim, you mentioned this, that there's sort of this idea the Democrats are saying, nope, we want to keep moving forward. The Republicans are saying, you've got now 6 weeks, like put your pencils down. So do we expect to see immediate changes starting January 20th? Or what do we think?
Well, my first impression is that there's, I'm not expecting pencils down between now and the time things change. In fact, I think over the last couple of weeks, the pace at which guidance and communications have been coming out have been accelerated. And you can understand both sides of that discussion. I think what we all have to remember is there are very dedicated staff at the SEC and the PCAOB who have jobs to do, and they're going to continue to get up every day and do their job, whether it's reviewing filings or responding to questions from registrants or auditors or inspecting audits. That work will continue while they figure out how things are going to proceed at the top.
All right. So maybe moving on, because if we spend this much time on all of our topics, it's going to be quite a long podcast.
We'll fly through everything.
All right. So let's move on, though, because I think another big thing that we see impacting rulemaking and otherwise are, what's going on at the Supreme Court. And we've talked about this a bit before, Kyle, on the podcast, the Chevron decision and otherwise. But what would you share from that perspective?
Yeah, I mean, look, I think Supreme Court's obviously the most important, right? Because that is the law of the land. I think, though, there are a number of actions that we've seen in other courts, right? Fifth Circuit, recently some actions, and the SEC has been sued on a lot of different fronts, right? With respect to rulemaking, with respect to, some of the enforcement actions they brought, the individuals they brought those enforcement actions against. So, but yeah, I think anytime you see a Supreme Court case that that actually impacts an agency. And so this one of them actually impacts all agencies, right? Federal agencies. And that's the one that overturned the Chevron doctrine or deference. And I'm not going to spend a lot of time talking about the case, but what I will say is it will have an impact. And I think the point there is that, when a good example to highlight it is the climate rule, that you have a final climate rule. And I think that, in a situation where an agency is not directed by Congress to actually take action and propose and adopt a rule, the deference given to that agency by the courts is not going to be there in the future. And so what will likely happen, what that means is that the SEC and other agencies are really going to have directives by Congress or, really be grounded in what their mandate is, mission critical. So if the mission is capital formation, investor protection, it's going to be a more challenging. You can't just say, well, it's the investor protection mandates. We think climate is important for investors to make an informed investment and voting decision, and so we're going to go ahead and propose rules. Well, Congress didn't direct the SEC to undertake that. They didn't direct the SEC to come up with required emissions disclosures. So I think that's going to be an important piece because everything that this next administration will try to accomplish, they're going to ensure that they are complying with the rules and the laws that are in place, and likely are not going to do a lot without having Congress backing what they want to do. The other one is the Jarkizi case, and that's really it's important to highlight because it may limit what the SEC can do with respect to enforcement actions. And so historically, you had an in-house administrative courts that were actually hearing these cases. These folks are hired by the SEC. They're hired by the commission and put into these roles to hear these cases. And I think there were a lot of conversations over the years over how that was just not appropriate. And we saw with this court case that the SEC essentially lost. And so their authority to essentially, they can bring actions, but to put them in front of an administrative law judge within the SEC, that essentially has kind of been thrown out. And so it doesn't give them that ability to bring, as many actions. There's a lot that likely will be challenged in the courts moving forward. So it'll be interesting to see kind of how that impacts this future, the agency itself. But I think as far as this administration, they are a Republican-led administration. They're probably not going to be really aggressive in their approach to either rulemaking or some of these actions they bring. They still will bring actions, right? And say they still will focus. I think what we see will be a focus on insiders, on individuals, more so than we see actions on companies. So I think we'll see a switch in kind of how enforcement does things. So I think in a nutshell, these Supreme Court cases will impact the rulemaking agenda of the SEC and will also impact the enforcement actions of the SEC.
So, Tim, I know you spent a lot of time visiting with clients, visiting with engagement partners, others within the firm. From your perspective, would you say that there's general understanding of the potential sort of momentous impact of some of the changes we've seen this year from these cases? Or is it, oh, yeah, I read something about that and not really grasping that actually this really is not business as usual anymore?
So I would say it is a widely discussed topic, but I would tell you those that are currently involved in either drawn out comment letter processes or those that are in enforcement already have a deeper appreciation for what this means. I think if you're one that follows SEC releases like Kyle and I do, and I know you do too, Heather, we can already start to see the impact just from the number of cases that have been dismissed and closed out. So, yeah, if you're paying attention, I think everybody understands the importance of both of these rulings.
Yeah, very interesting. So maybe let's go on then to talk about some of what's sort of date today, I'll call it, at the SEC. And I think there's two topics we've spent a lot of time thinking about and talking about. And again, ones that there may be some changes next year, but starting with the first headline would be crypto. And again, that's something I think that came up last week, Kyle, or at a minimum has been in the headlines quite a bit since we've had the election results. So what are we thinking from a crypto perspective, what we might see?
Well, I think the broader implication goes beyond kind of what we'll talk about with respect to the staff accounting bulletin that addresses the particular requirement or gap requirement with respect to crypto, and I think the thing that I look to is the fact that it's very unclear what would constitute a security under the federal securities laws. And so we've seen a lot of offerings or companies trying to do offerings, but it's not very clear as to if something is a security or not. And so the SEC certainly has brought a lot of actions. And so a lot of the commentary from the Republican side of things has been, hey, you should not be bringing, these cases and you're regulating by enforcement. Set up a framework, help companies determine what should be subject to the analysis, how to walk through the analysis. So set up some sort of framework. Maybe there should be rulemaking. But I think the other piece that we heard from Commissioner Ueda at the conference was they're going to be looking to rescind SAB Topic 121. And so that's the staff accounting bulletin that covers crypto and custody and essentially the grossing up on the balance sheet of the asset and then, of course, the related liability. But I think the question there is then going to be, all right, well, how do you undo it? Like, how do you do it quickly? What does that look like? Companies have already put this. A lot of companies have put this on their balance sheet already. And so do they just rescind it and take it off the balance sheet? What does that look like moving forward? So I think a lot of things for them to think about. With respect to the SAB topic. You're making a face. What was that?
Well, so I know we're not supposed to go into detail, but I have to ask this question because I'd be remiss if I didn't. So if we see immediate action on this, then what does that mean for companies? So January 20th.
Good question.
And
is
then
it a
it's
transition period?
Yeah, it's right in the middle of the reporting period.
And that's what a lot of lawyers are worried about,
right?
Like there are lawyers that are really concerned. And when you think about securities lawyers, right, they're always thinking about class action lawsuits and from investors. And an investor says, hey, I invested in this company because of their assets. Well, those assets are not – they may be restated, revised, or changed. And so if that's the case, what does that look like? I don't know.
Yeah, there's been a lot of talk about that. Is there an effective date? Is it no longer GAAP or – what might be the most likely outcome? Is this an accounting that is preferred, and do you go through the preference letter process and deal with it that way? I think it's fair to say that there's a lot of debate about whether that's the right accounting, and the people that are trying to deal with that are not in the details enough to understand. Like once the decision is made to repeal it, then how do we deal with it? So.
Yeah, and I think, Tim, that kind of goes to, if I understand another message we're starting to hear from companies is that stability is also important. And so some of these changes are good, but also knowing what the rules are is good. So,
I think that's the approach that or the thing that we talk about the most, and I talk about most personally. It doesn't matter whether you're talking about the SEC or the PCAOB or rulemaking or accounting rules. I think preparers and auditors and investors, they just all want something that's consistent, understood. Everyone knows how to measure it. Everyone knows where the bar is so that we can continue on with getting
How do I stay in that
reporting.
fairway? How do I stay in the fairway?
And you don't want the fairway jumping in the middle of year end for many, many companies.
Yeah. One of the themes that we heard over and over in the conference was a desire or a comment that said everybody in the room was really here because they're interested in good, accurate, transparent financial reporting, and that shouldn't get mired down in politics. And so I think what we're all saying is we hope that, we're accountants and we're not politicians, and we'd like to just stay in that lane.
The thing, though, that I would say to that, too, though, Tim, is, I agree. But I think it's important to understand that politics do have an impact and influence our profession today. And it's what, you can have whatever view you want on it, but it is a real thing because of the oversight function of Capitol Hill over regulators, over Wall Street, right? So it's not going to go away anytime soon. I think it will continue to look a lot like this. I think the one thing I say, kind of the silver lining, it is at least we're relevant. At least the profession's relevant.
Well, that and the old adage that be careful what you wish for,
exactly.
You may get it.
Yeah.
I think everybody needs to understand that what may look good in 1 year may not look good in the next, and moving from one end of the spectrum back to the next is a tough way to.
A perfect segue into the PCAOB.
It is, although I have to say, I think people also could cope a little better with this. It was the middle of the summer instead of the middle of the winter.
Fair.
But
right.
in any event. All right, I was going to stick with the SEC for two more topics, then we'll go to the PCAOB. Okay. This one I think is maybe a little more straightforward. Again, probably not something you normally hear with this topic, but cyber and the SEC rule. Again, not that the rule itself is straightforward, but compared to some of these other things. But what's the latest on that, Kyle?
Well, I think it's important to highlight it, right? Because what we heard, there was a cyber panel at the AICPA conference, and we actually had some really good speakers. We had some lawyers speak, a couple of lawyers that actually have an accounting, or actually all three lawyers on the panel had accounting backgrounds. And then, you also had a regulator. You had the SEC up there. And I think the message here is, look, don't assume that the SEC is just going to kind of roll over. I mean, the SEC will still be focused on cyber. It is a concern of both sides of the aisle. I think this, when you look at some of the disclosure requirements, setting aside the incident reporting in the Form 8K, we don't need to spend a lot of time on that. But I think it's important for companies preparing for year end to think about their disclosures, the annual disclosures in the 10K, because I can tell you that the comments we're seeing and what I expect we'll see over the coming 6 months will be a heavy focus on those disclosures and ensuring they comply line by line. And so I tell a lot of companies, go through your current disclosures today. You had a year, you had a trial run. Go through those current disclosures, compare them to what is required by that item, by the rule, and ensure that you've addressed every single point there. Because if you've not, we've seen the staff ask questions. You never know. They may tell you they want you to amend the filing to include more detailed disclosures. So that can be an inconvenience. So you're better off kind of making sure that you comply with those disclosure requirements as written. Well,
and obviously compliance is extremely important. So my next question is not to suggest otherwise, but you did make a comment about SEC comments over the next 6 months. We've also just been talking about this change in administration, change in commissioners and otherwise. And sometimes I know we've talked in other forums that can impact the SEC comments, but it sounds like, Kyle, you think in this case that just...
Everyone asked that question, and I can tell you just from my experience, it takes a little bit of time before things trickle down. You typically see kind of a change overnight. Obviously, you'll see it with rulemaking. The agenda will change. With the enforcement division, you'll see some changes pretty quickly. With respect to other divisions and offices throughout the agency, it takes a little while before things trickle down to the staff, unless they're given a directive. And so, when I look back to the last administration, the leadership team gave this, Corp Fin team the directive to issue more comments. And we saw that. And we saw a lot of good, targeted, laser-focused comments on a number of topics. And I would say we probably will see that continue until they're given a directive, hey, take your hands back a little bit, lay off, on some of the comments, or, hey, maybe we don't need to focus on, let's say, climate compliance with the 2010 interpretive guidance that says, talk about climate risk and your risk factors, all of those related disclosures, setting aside the climate rule that's out there. This is what is required today. If you have a risk and it's material, you should disclose it. Do I think this future SEC leadership team will be issuing that comment? Probably not, but you never know. But
to the point, sticking with what we were talking about with cyber in particular, we can expect, at least if you are predicting, to continue to see comments. And again, compliance with the rules is always something that we
pretty straightforward.
Be supportive of. Yes, exactly. All right. So you mentioned enforcement. So perfect segue into my other SEC question before we move on, which is to go to you, Tim, and to talk a little bit about enforcement and anything broad that we'd want to talk about. either related to cyber or otherwise?
Well, sticking on the cyber conversation, the other thing that I think gets a lot of talk and we've seen come across is as you're making your disclosures or you are responding to comment letters, make sure that there's a clear understanding about what your company is currently doing versus what is aspirational or intended.
Love that point.
I think even with the best intentions, sometimes it's easy to overstate things that are being done on the cyber front or things that happen during an event. And I think we just all need to be very clear and make sure we're sticking to the facts. The other things that stick out along cyber was, and I think we've been saying this, Kyle, I heard you say this a year ago, is, trying to understand when disclosure is necessary is challenging, particularly when you come to the point in the process when you have to determine whether it's material. And to have a well-documented process that talks about who makes that determination, what factors to consider, the process about what goes into it, along with a real-time contemporaneous documentation of those discussions are very important and very compelling as you're having discussions with the staff. From an enforcement perspective, I think the courts have made it clear that that Sarbanes-Oxley is limited to controls over financial reporting, and that controls over cyber incidents and the like do not fall into that category. However, please be careful about how you think through disclosure controls and procedures, because what clearly covers them is how you describe them and when you disclose them, and those are part of DCMP. And so if you have controls out there that don't have someone in your CISO organization or other parts of your IT organization, I think it's important to get them involved in that process and, again, have those documented.
All right, good reminder before year end on that. So let's stick with regulators then and move on to a regulator. I don't think we really spoke about on the podcast before this year, because I think traditionally there's been a view that the PCAOB is the auditor for us, not for companies. But what we've seen over the past year, or maybe a little longer, is that the PCAOB's rulemaking impacts accounting firms, but then also trickles through and impacts companies. Now, I think probably a big question, and again, coming from the conference last week, is do we expect that trend to continue? And then once we set sort of that stage, we can talk a little bit about some of the specific rulemaking. So maybe, Tim, I'll go to you.
Sure. So when I think about the past 12 to 18 months and the PCAOB, the thing that sticks out is just the volume of rulemaking. It's been intense, to say the least. I think there's been 10 proposals for new standards, 10 projects finalized in various states. I think generally, as you point out, Heather, many times preparers, are not as interested in what this rulemaking is. I think once NOCLAR was introduced for the first time, a lot of stakeholders started to be more engaged and more attentive about the rulemaking process. And what those rules were. So as for NOCLAR, I think everybody knows for now, at least, there's not an expectation that final rules are going to be proposed. So I think that's on the side, and we'll see what comes of that. The two proposals that are out there now that are getting the most attention are rules over reporting of firm metrics and reporting of engagement metrics. Again, I think most folks would think those are more auditor focused. One rule requires publication of certain information about an accounting firm. The other rule on engagement metrics requires certain reporting of specific engagements and specific clients and registrants. I'll talk more about the engagement metric proposal because it impacts, I think, both preparers and auditors. And it really is requiring auditors to file in their Form 10K detailed information about the audit. That includes information about hours spent on the engagement, a breakdown of those hours by staff level, things like hours of training by individual and years of industry experience. And There's a lot of controversy around it because there is, I think, some strong disagreements about what is the cost of providing that information versus the perceived benefit. I think companies now are starting to get engaged because they're also concerned about what might be inferred by someone who doesn't have experience with auditors, doesn't have access to have discussions with the auditors of the company. What things could they interpret out of the data that may be misleading or result in a different answer or a different conclusion on quality? So there are a lot of concerns about that. Those rules have gone now to the SEC for final approval. We're in the final comment period. I think the letters are due right around December 25th. So as somebody at the conference said, happy holidays. So we'll see what happens with them. But that's probably the new rulemaking activity that's getting the most attention.
Yeah, I think kind of layering on that, Tim, just the point about like the benefit, right? Like, I mean, clearly, it's how does it contribute to audit quality, right? I think that some of the other standards that the PCAOB has proposed and adopted, you can see how it would contribute to audit quality. I think the conversations I've had, with a number of folks kind of across the profession has been, well, how is this going to contribute? And so I think that's going to be the big ticket item with that one.
I think you're right. I would also say all the firms today, at least the bigger firms, provide audit quality reports that try to give visibility into similar metrics in a much more detailed fashion. And the benefit of doing it in that environment is that you have the ability to provide a lot of context and narrative about what the numbers mean. I think also as the audit rules are changing and as the use of technology is increasing, the audit is changing dramatically. And so the metrics on individual engagements, they are changing and they will change at an even more rapid pace over the next 5 years than they have in the past. So the metrics being proposed today, how relevant are those going to be 5 years from now? And what's great about the use of transparency reports by audit firms is you have the ability to change those metrics over time, continue to lay out the ones you have historically, not so that everybody sees what happens to metrics over time, but also introduce and change with the environment. We think that that's a very important point.
But I guess if I just take a step back and, I'd be remiss if I didn't say for people who want to know more about all these proposals and everything else, they should listen to the podcast I did with Brian Croto because we go into a lot of detail and talk about pros and cons and some different things. So I do think that's important background. But if I just think about this conversation and what Tim described in terms of these metrics and the sort of burden and otherwise, and I put this in the context of the discussion we had about the election and potential changes at the SEC. I mean, Kyle's terrible at predicting things. Maybe I should ask Tim.
I can predict this stuff. That's about it.
Do we expect that these rules will move forward? And maybe more broadly, do we have any big picture expectations from PCAOB perspective?
I think it's tough to say. I think if you do the math about the number of days that we all have to respond to the SEC and the number of days the SEC then has to put it into effect, which then requires the vote of the SEC commissioners, there is time in that calendar to get that passed. I think the unknown is the level of a number of comments that the SEC receives. They have to review those and weight them and factor those into the decision. So their ability to get it done in that time is going to be somewhat dependent on the number of comments. As to whether it's going to get passed, I think they're going to work hard to get it done. I do feel like there's going to be a lot of comments, so I think that they're going to have a big task ahead of them. But if I had to put money down, I think it might pass. Yeah.
But then I guess, so it passes, then the new administration comes in, we have new SEC commissioners, then what happens next?
So it's interesting, right? Because the budget will be approved pretty soon for the PCAOB. So then the SEC approves that budget. So they're not going to be able to kind of hold the purse strings, at least for now, I don't think. The other piece is, there's a lot of commentary around, well, is it subject to the Congressional Review Act? And I think
which I do not have a straight answer.
Which we don't have a straight answer. I think the impression I get from talking to a number of folks is no, it would not be. But could Congress take some sort of action? What vote would they have to get something to move forward? There's a lot of questions about what this administration can do. But there's certainly a lot of strings they can pull to maneuver and figure out how to kind of maybe potentially soften the blow. But whether they are wanting to do that, I think remains to be seen because we just have no idea who will the next – if there is a new leadership team, what that leadership team at the PCAOB will look like.
Right. And I also wonder the new boards, like where is this going to fall in their priority? They've got a lot of things that they're really interested in addressing. I'm not sure this makes it to page one.
Yeah.
But I guess maybe a key point before we move on to the FASB, we talked earlier in this conversation about SAB 121, and it's going to be a priority to undo that. Now we're saying this one, we think it's going to pass. And then we start talking about all these other mechanisms that would be needed to undo it. And I think maybe, Kyle, this is not a podcast about rulemaking, but it might be helpful perspective for people to understand why the difference between what the commission can do with SAB 121 versus if this rule is adopted.
So with SAB 121 is a little bit, it's unique, right? Because it is a staff position. So if the staff, the SEC publishes something, that can be rescinded like tomorrow, right? So there's a lot of staff positions out there. And then now, obviously, anytime you rescind something, it obviously has consequences.
Well, obviously, yeah.
But again, and we talked about the SAB 121 case. But I think as far as like rulemakings, right, there is what they call the Congressional Review Act, where when there is a transition, you can revisit rules that let's say the SEC has adopted within a certain window, and Congress could step in and say no, we're going to overturn that. We don't agree with it. We don't like it. In this case, right, it's different because this is the PCAOB. The commission of the SEC approves these rules, and is not subject to. But I think the question is, well, through Congress's oversight of the SEC, then how does that impact? And is there something there that they can pull back on? I don't think I've heard anyone say or point to anything where they can say they've said, hey, all these PCAOB's rules that have been adopted over the last, or the standards have been adopted over the last year, no one has said to me that those are to be rescinded. And I think like with NOCLAR, the non-compliance with laws and regulations, what we've seen, what we've heard there, obviously that's the reason why they kind of held off on that one, because I think very polarizing topic, one that I think had they really pushed hard to push through, I do think that one would get a lot of comments and would have taken them a long time, whereas I think this one on firm and engagement metrics may not be worth it. And I think firm and engagement metrics is not going to get a a commentary.
No, it doesn't sound that interesting, actually, just like from a title point of view.
Right.
All right. Well, it definitely sounds like we need to Brian
I do
back.
think, just one last thought. I do think there's going to be renewed focus on cost benefit. I think there's been a lot of questions about the rigor and at the SEC into those analysis.
And at the SEC.
And so I do think that's something that's going to get a lot more play.
And that was one of the things. I'm glad you brought that up because when we heard from the congressman French Hill, he had indicated that they want to revisit kind of the cost benefit, essentially your economic analysis, the Administrative Procedures Act, certain things that are in place. And I think when you have a majority in the House of the Senate and, of course, the White House, the potential to make significant change.
Yeah. Well, it definitely sounds like we need to Brian back to explain some of this. Because again, given all the potential sort of flow through impact to our clients. All right. Couple more topics I wanted to hit.
I don't think he's available. I think he's working on a comment letter.
Well, he and I did a podcast on the impact of a lot of this stuff on companies for year end. So the impact on preparers. So that's a good podcast.
That's right. And that'll be coming out. So people should listen to that.
Yep.
So just trying to remind people that you were our guest host there.
That's
Kyle.
right.
So,
I was the guest host.
all right. There we go. So a couple more topics here, one of which is the FASB. And on this one, I don't want to go too much into detail of the rule of the new standards that have been issued, recognizing that this is an accounting podcast. But I think what is probably of maybe bigger interest from a listener point of view for this particular podcast is where does the FASB fit into all this? So we've seen some big rulemaking. I mean, we saw the segments, we saw DICE, we saw the income tax disaggregation, and they just seem to be sort of continuing with their agenda, notwithstanding all this, I'll call it turmoil otherwise. And, again, from your point of view, what do you think?
Yeah, well, I think the FASB will continue to set their agenda and focus on making good rulemaking and with good due process. We'll see if 121 gets thrown back to them. I think for the moment they're very busy on segments and DICE and the new income tax disclosures, and they've got a pretty full plate there. So I don't see dramatic change coming down through the FASB. I do see some work for preparers in adopting those three new standards. And I would say that generally what I hear is that I think on DICE in particular there were a lot of concerns raised initially around several items, and that the rules they have now been approved was very responsive to those rules, and I think is much more palatable in the final standard. And I think what many would say is, boy, if we could get that process going with all rulemaking, it would be a step in the right direction.
I think that's kind of the same that I've been hearing too. Is with DICE is just the fact that the voices were heard. And I think what a lot of the reaction or response to kind of the SEC's rulemaking, a lot of folks kind of their view is, well, we're providing comment, but is the SEC really listening? So I do think that when you talk about kind of what's going to happen at the FASB, I think the thing that I think about is, are they going to still go down this path of focusing on investor protection? Of course they will, right? We're certified public accountants, right, for a reason. And they're looking for this granular information. Investors want that information, for years, number of years in a row, probably frankly from 2016 to 20, when I was at the SEC, we met with investor groups constantly. Analysts, they want more information. Obviously, they want the general ledger, right? They want what they can get their hands on, whatever company's willing to give them. But that is not going to stop. They're always going to ask for more. And I think the question is, to your point about cost benefit, when the FASB is doing their work, is ensuring that they really are balancing kind of their mission and thinking about the cost benefit for some of the standards that they're doing.
Yeah. Now, if you were talking about what new standards are we getting the most discussions about, I don't think I would say DICE. I would definitely think segments would take the top
absolutely
of the list.
And,
measures of profitability and single segment reporting and the like. I'm sure you guys have done a podcast on that already.
We have. Okay. We have a podcast with our deputy chief accountants talking about a lot of these topics, accounting across the board. So that's certainly something that people can look at. But we do have individual podcasts on a lot of these topics too. So
yeah, maybe the last comment or question on this one, Tim, is again sort of taking your perspective from all these companies, and PwC people that you're speaking with. Are you feeling that people are ready for this? There's a lot of additional detail. It's a lot of additional work. And again, it does sort of seem like there's a lot of other things overshadowing adoption of these standards.
So I think as it relates to segments, the one that I'm a little worried about is whether single segment reporters have really understood what all of this means to them and aren't simply saying, well, I'm a single segment. This should be pretty,
I don't care about this.
Pretty easy. And then, I think there's been a lot of healthy debate about, how to report certain measures, how to decide what information to include, and certainly the whole topic about a second measure of profitability being well debated. I mean, this is the kind of stuff that I joined and stayed in the profession for as long as I have.
Not the earlier part of our conversation.
Because these are interesting to me. Yeah. These are interesting
and important. I mean, very important from an investor perspective.
On the segment, to your point about the measure of profit or loss, that additional measure that if it's not calculated in accordance with GAAP, right, then you have to comply with the SEC's non-GAAP rules. Like it's that issue has been discussed at least I'm on the SEC, the CAQ's SEC Regulations Committee, where we meet with the SEC to talk about a lot of different topics, reporting topics, and this is one of them. I mean, it was up until last month or the month before. I mean, it took since the AICPA conference last December when they were talking about all of this to 10 months later before we actually had kind of gotten some feedback or reaction from the staff on a lot of the questions that we assurance providers, others had, preparers as well, but on the topic itself. I think that the biggest piece that stood out to me when you were talking about, the single segments, whatever, is really, even for those companies, right, it's the importance of controls, processes and controls over this. And like, you better be paying attention to single segment companies, because this is something you're not just gonna have to do it at year end. This is a quarterly reporting thing, right? It has a quarterly reporting impact. And so you will have to think about your significant segment expenses. And that's not something that companies, some companies have disclosed them over the years. You certainly see a lot of companies that have a lot of detailed information. But again, I think it's what does that look like? And I do think segments is an area that's ripe for comment, because nothing is changing with respect to how you determine your segments.
That's a great
right?
point. Yep.
So the staff's going to look at it and say, we're coming hard at you, because nothing's changed on the analysis of what's an operating segment, what's a reportable segment. What's changing is going to be additional disclosures. The staff loves to issue comments on additional disclosures, and they will be focused on that. And I think we heard it from the people we heard from CorpFin at the conference, but then conversations we had with some folks that seem to think that it's going to be an area it's top of the list. It always is top of the list anyway. So I think it's going to be number one next year.
All right. I'm going to keep track of this prediction, Kyle.
This prediction is going to be right.
All right. Let's move on talking about predictions to climate. We can't skip that. And I know we talked about this briefly earlier, but I do
Didn't I say in a webcast that I think the outlook is bleak?
Yeah, you did say that. But
I've heard others say that they think it's dead. That's
although
what I've heard.
I heard that it wasn't quite so negative that the conference last week as to say, well, it was completely dead, but I guess more to come.
I didn't hear completely dead, but
I didn't hear completely dead. I did hear it from some folks, and I've actually heard that from Roz Brooks, our public policy leader. So I think that there's a lot of that. Again, we talk about the strings that can be pulled by the new administration. So irrespective of what happens in the courts, what I will say is if the chamber does not prevail, right? The chamber is sued, and this is the SEC, and this is in court. If the chamber does not prevail, right? And some or all of the rule is, yep, you're good to go. SEC, go ahead and implement these new rules and come up with compliance dates. The chamber will likely appeal, and the question would be, if they appeal, who at the SEC is going to want to continue to defend this? Right. Mm-hmm. Not the new leadership team, the current leadership team, but they're going to be gone as of 1/20/2025.
Yeah, I mean, I think, though, in some ways, this talking about the SEC climate rule, it's interesting. However, it's really a distraction from what's really going on from a sustainability reporting perspective. Yeah. And I do think companies that are overly pivoted onto the SEC rule and not paying attention to California, not paying attention to Europe, not paying attention to all the jurisdictions that are adopting ISSB, you're missing the boat a little bit there. So again, from a reminder's point of view, what are you thinking from sustainability perspective?
I think that's why I didn't hear people saying sustainability is dead.
Sustainability is not. Climate maybe, from the SEC.
Maybe
sustainability
climate.
Absolutely is not.
For sure.
I agree. Yeah. Look, I think it's imperative that companies continue. I mean, I don't assume that, the suit of California, the chamber suit of California for them imposing their requirement, don't assume that that's going to have maybe a similar outcome, or so it remains to be seen what will happen there. There's rumors kind of back and forth on that. I think I think the message we've been, kind of delivering, because there are some requirements today, right, for reporting, and we won't get into all the details on all that because there's an awful lot. But what I'll say is, when you think about the greenhouse gas emissions disclosures, the potential, the requirement potentially for limited assurance, and then one day reasonable assurance, this is not something that companies can ignore. And I think, we've talked about this, Heather, in a number of webcast podcasts of, the positive here, I can say, kind of the silver lining is there is commonality, right, with respect to CSRD and California. But CSRD, you've been working on it. There's a lot to unpack there. And right now, there's only a few companies that are going to have to report 2024 in the US, right? In 2025 reporting on 2024 data. But that's going to really be a huge number next year and then thereafter. And so I think that's going to be a huge burden for companies. There's a lot of disclosure requirements, a lot of reporting that needs to happen. And so you got to make sure that you have the controls in place, processes and controls, you have the right people, you have a cross-functional team focused on it across the organization, that everyone has a seat at the table, that there is communication, that you understand what's required. We talk a lot about this, like, where do you have to report? Are you scoped in to, do you have to file in or report in California? Do you have to report in, where in Europe do you have to report? And thinking about all of those reporting obligations similar to what you do with statutory reporting and ensuring that you are in a position to comply with these requirements. And then understanding, okay, there are commonalities. What can we leverage across each of these locations we have to report? But we know there's a lot in CSRD to unpack. I think that's going to be a huge challenge for companies and an area that's going to continue to evolve, and really an important kind of plug for our continued, thought leadership in this space, because it is evolving on a daily basis. You give me updates like
morning
weekly.
And afternoon.
Absolutely.
Yes.
Absolutely.
Yeah. The only thing maybe, Kyle, I agree with what you said. There's one characterization, though, that I think some of our colleagues in the corporate reporting space and Nadia Picard and others would probably take exception to, which you framed this as a burden. And I think based on some of the studies and other work that they've done and doing benchmarking and surveys and otherwise with companies that are in wave one of adoption of CSRD, truly there is also an opportunity in terms of integrating with your strategy and otherwise.
I would say that when I say the word burden, it applies to multiple requirements.
Yes, 100%.
And I think that's going to be the challenge, right? Global reporting and getting to a consistent place. It's like you talk about IFRS and US GAAP convergence. Like, is there going to be convergence? Can you leverage your reporting in other locations to report? And I think that's the big burden, is just keeping up with where you have to report, what the requirements are. But I agree with you. I think as far as opportunities, leveraging your ability to kind of capitalize on those opportunities, we're seeing that, and we're going to see it in the reporting, right? And I think you see it with the EU taxonomy and kind of how you prove that out. That'll be very interesting.
I think this whole thing is very interesting in terms of seeing what's going to happen next. So more to come, and I think that's a topic for a whole other
we'll leave that
series
for a rainy
of podcasts. Yeah. As it's raining as we're recording this. Okay, gentlemen, we've talked about a lot today. I think hit most of the hot topics. So maybe I'll go to sort of dealer's choice and player's choice, and let you guys choose your final topics and sort of your final thoughts or key reminders for the year. So Tim, to you first.
Well, what kind of podcast would it be if we didn't talk about AI?
Fair enough.
Certainly continue to have a lot of discussions on AI, although I would say that those conversations are really starting to evolve in a more meaningful way. I think we're all now talking not about AI, but we're talking about specific types of AI. What tool are you bringing to solve a problem? Is it machine learning? Is it a generative AI application? Are machine learning and AI too overbuilt for the function? We're starting to get a lot more discussions about bringing the right solution to the right problem. I would say we're seeing companies that are much further along today than they were last December, but we haven't really seen a lot of companies deploying AI in large scale, significant, meaningful ways. They're really more looking at what are the best use cases, and then how do I get them through our governance structure and what should that governance structure look like. And so I'm encouraged by the fact that everyone seems to be coalescing around the need for a governance structure to begin with, which is a big first step. And then also, like, what are the risks about, you need to think about, what are the risks on the inputs? What are the risks on the corpus that are being used? What are the risks in the output? How do you test them? How do you take responsibility? How do you make sure you have the human intervention needed to get to the right answer? And so those are all the right things to be focused on, and those are the things that we consistently hear. So I think that's my topic of choice, and I would say my prediction for 2025 would be that we'll see a lot more use of AI tools next year than we have this year.
I feel like Kyle could learn from you about making predictions, because I think it's highly likely yours will come true.
Prediction. That's easy.
All right, Kyle.
So you know what I'll say to that point, because I think that's a great point. And it was funny because we did a CPE session this morning with our TMT practice.
So technology, media, and
telecommunications. Yes.
Okay, so that would be our technology, media, and telecommunications practice for our listeners' benefit.
So we actually talked about the AICPA conference, what we heard, and then you had you talked a little bit about the SEC, you talked about the FASB, you talked about the PCAOB and other panels. And we didn't get a lot of questions. So I figured, okay, well, maybe I'm not that interesting, so no one's going to ask questions, or
there's a bold prediction.
But it was interesting because what I actually was talking to one of our auditing folks who presented. She said she got a ton of questions on generative AI, and so I think, to your point, right, as you think about financial reporting and also kind of the audit, as well, I think we will obviously see a heavy focus on that in the coming year. I guess my takeaway in all of this would be really just paying attention to kind of what's going on with the SEC, the FASB, and the PCAOB. And as much as we talked on this podcast about, hey, people provide comment and different reactions to whether these regulators or standard setters actually listen to the feedback. I mean, look, their job is to do what they are tasked with doing. So the SEC in their oversight function, right? Gary Gensler tasks the team and says, here's what I want to accomplish. And then they, put something out, and then they get feedback, they get comments, and they consider those comments. They're required to consider comments, and they do. And they go through, and as my time working on rules, we spent a lot of time pouring through all the letters that were sent in on rulemakings to evaluate, okay, what's in here? What does this mean? Have we thought about this? And you kind of run that down. All of these regulatory and standard setting bodies, they do that. And so it highlights for me the importance of engaging with our regulators and standard setters, not just the accounting firms, but also, preparers. And whether that's through industry trade groups or whoever, I think it's important for people to pay attention to what's coming down the pike, because obviously it's going to impact everything that the organization does moving forward. And so, as I think about kind of what's going on at the FASB, there's a lot that's on the agenda. They're focused on software. They're focused on updates to CECL. They're focused on environmental credits, which I know is an area that you've been following, our team has been following. So I think that the important message here is stay engaged and provide input.
All right. Well, gentlemen, it's always such a pleasure to talk to you. It should be interesting to see what 2025 brings. Thanks so much for joining me today.
Thank you.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.